Welcome back to Intelligent Investment Today, the podcast concerned with all things value investment. In each episode, we take another topic from the world of investment and attempt to apply the lessons as laid down by its founding father, Benjamin Graham, to the matter at hand. In this edition, we're going to take another look at the efficient markets hypothesis. If you're already well versed with this piece of intellectual mumbo-jumbo, then that's great. This episode should act as a timely reminder. If not, don't fret. It's nowhere near as complicated as it might first sound. And by the end of the episode, you'll be an expert in the field. We will consider exactly what the hypothesis is, why it often evaporates upon contact with reality, while at the same time not being completely wrong, and why understanding the concept gives the value investor a vital head start in comprehending why value investment works, and why it will always work, so long as it's humans making the investment decisions. So as ever, let's get right down to it. Sit back, tune in, and get ready to take on board another lesson in value investment as inspired by Benjamin Graham. Imagine two people standing in front of the same stock chart. One looks at the price and says, "This number already reflects everything we know. You can't beat the market." The other looks at the same price and says, "This number reflects fear, greed, rumours and human mistakes. If you're patient, you can find bargains." Those two viewpoints represent one of the most important debates in the history of investing. On one side stands Benjamin Graham, widely known as the father of value investing. On the other side is the efficient market hypothesis. This argument isn't just about money. It's about how humans behave in groups, how much we trust crowds, and whether logic or emotion ultimately drives decision making. So the real question here is simple but deep. Are the markets smart? Or are they just moody? To understand that, we need to understand how differently Benjamin Graham and the efficient markets hypothesis see the world. Benjamin Graham was not a flashy figure. He didn't chase trends, make bold predictions, or sell excitement. He was quiet, methodical, and deeply sceptical of emotion. Graham came of age during one of the worst financial disasters in modern history, the Great Depression. He watched markets collapse with incredible speed. Fortunes disappeared, panic spread, and prices fell far below what the underlying businesses were actually worth. What struck Graham was that many of these companies didn't stop producing goods or providing services. Factories didn't vanish overnight. Customers didn't disappear completely. Yet stock prices behaved as if the world had ended. From Graham's perspective, this wasn't logic at work, it was psychology. And that experience shaped everything he believed about investing. To him, the stock market was not a precise calculating machine. It was a collection of human beings reacting emotionally to uncertainty. This idea led to one of Graham's most famous concepts, of course, Mr. Market. Mr. Market is an imaginary business partner who shows up every day offering to buy or sell shares of a business. Some days he's euphoric and wildly optimistic. Other days he's depressed, fearful and desperate to sell. The key insight Graham wanted investors to understand is that you're not obliged to listen to Mr. Market. You can ignore him. And you can wait for him to offer a price that makes sense. Graham's core message was this: the market exists to serve you, not to instruct you. That belief only works if prices are sometimes wrong. And Graham firmly believed that they were. This brings us directly into conflict with the efficient markets hypothesis. The efficient market hypothesis sounds intimidating, but the central idea is straightforward enough. EMH claims that all available information is already reflected in stock prices. As soon as new information appears, millions of investors react to it almost instantly. Because of this, prices adjust quickly and efficiently. If a stock looks cheap, EMH says it's cheap for a reason. If it looks expensive, that price reflects real risks or high valuations. Any apparent mispricing is likely an illusion. The logical conclusion of EMH is that consistently beating the market is nearly impossible. Any success is more likely to do with luck than with skill. This idea transformed investing. It gave rise to index funds, passive investing, and the philosophy of simply buying the market rather than trying to outsmart it. And here's where things get just a little bit uncomfortable. A lot of evidence supports the efficient markets hypothesis. Study after study show that most professional fund managers fail to beat the market over the long run. Even investors who outperform for a few years often revert back to average results. From a statistical standpoint, EMH looks strong. So why exactly didn't Graham accept it? Because Graham wasn't focused on statistics. He was focused on behaviour. The real disagreement between Graham and EMH isn't about information. It's about how humans respond to information. EMH assumes people process information rationally, while Graham believed that people process information emotionally, especially under stress. Graham didn't argue that information doesn't matter. He argued that humans consistently misuse it. People panic during crashes. They sell not because the business is broken, but because prices are falling. People chase hot stocks not because they've done careful analysis, but because everyone else seems to be getting rich. People anchor to recent prices. They overweigh dramatic news. They follow crowds even when logic says not to. Because of this, Graham believed prices regularly drift away from true underlying value. And this is why Graham focused so heavily on margin of safety. Instead of trying to predict the future perfectly, he wanted investors to buy assets at prices low enough to absorb mistakes, bad luck, or uncertainty. The hypothesis says that prices are accurate reflections of reality. Graham says prices are opinions, and opinions change. This disagreement becomes particularly clear when we talk about market bubbles. If markets are efficient, how do bubbles exist at all? Consider the dot-com bubble. Companies with no profits and sometimes no revenues were valued at enormous levels. Or the housing bubble, where prices rose far faster than incomes. Or the modern speculative frenzies driven by hype, social media, and fear of missing out. In these moments, prices didn't rise because of slow, careful analysis. They rose because stories spread and emotions fed on themselves. Graham would say that these episodes prove his argument. Markets don't calmly assess value. They swing from optimism to pessimism and often overshoot in both directions. Supporters of the hypothesis usually respond with a sharp but important counterpoint. Yes, bubbles may exist, but recognising a bubble doesn't mean you can't profit from it. Many people who correctly identify bubbles will still lose money because timing is incredibly difficult. This is where the debate becomes uncomfortable for everyone. Benjamin Graham's philosophy sounds logical, but it is also emotionally demanding. Value investing often means buying companies that look, on paper, unattractive. It means being early, which sometimes feels the same as being wrong. It means underperforming during exciting bull markets. It means waiting while others seem to be getting rich quickly. Most people admire value investing in theory. Very few enjoy practicing it. The efficient market hypothesis doesn't ask you to be brave or independent. It asks you to be humble. It says you're probably not smarter than the market, and that's okay. That humility can be freeing. And this leads to an important realization. EMH might not perfectly describe how markets behave at every moment, but it might describe how most investors should behave to avoid mistakes. So maybe Graham and the efficient markets hypothesis are answering different questions. Graham is asking, how can a disciplined individual protect themselves from market emotion? EMH is asking, what happens when millions of imperfect humans interact at scale? Seen this way, they're not complete opposites. They're describing different levels of reality. Graham focused on the exceptional investor, patient, disciplined, and emotionally controlled. EMH describes the average outcome of crowds. And this distinction becomes clearer when we bring Warren Buffett into the conversation. Buffett studied directly under Benjamin Graham and openly credits him with his intellectual foundation. But Buffett also admits that he changed Graham's approach over time. Instead of buying purely cheap assets, Buffett focused on buying high-quality businesses with strong competitive advantages, even if they weren't extremely cheap. And that evolution quietly acknowledges something EMH gets right. Information today spreads faster than it did in Graham's time. Accounting tricks are harder to exploit. Obvious bargains are rarer than they once were. Pure cheapness is no longer enough. Buffett once joked that if markets were perfectly efficient, he'd be performing tricks on the street for spare change. Yet at the same time, he strongly recommends index funds for most people. That isn't hypocrisy, it's realism. Buffett understands that exceptional discipline is rare, and that most people are better off accepting market returns rather than trying to beat them. So who wins the debate between Benjamin Graham and the efficient markets hypothesis? Although it pains me to say, the honest answer is that neither side wins completely. Markets are efficient most of the time. They are inefficient some of the time. And they are emotional all of the time. Benjamin Graham teaches investors how to survive when emotions take over. The efficient markets hypothesis teaches investors not to assume they are special. The danger comes from misunderstanding either one. If you believe EMH too rigidly, you may ignore obvious periods of irrational behaviour. If you follow Graham blindly, you may overestimate your patience, discipline, and emotional control. The smartest approach often borrows from both philosophies. In the end, this debate isn't really about stocks. It's about how you see human behaviour. Do you believe crowds are wise or reactive? Do you trust prices or judgment? Do you value humility or independence more? Benjamin Graham believed emotional control was the ultimate edge. The efficient markets hypothesis believes the absence of an edge is the starting point. Maybe the most reasonable position lies somewhere in between. Sceptical of the crowd, but sceptical of yourself too. Benjamin Graham didn't try to outsmart the market. He tried to outweight it. And that may be the most timeless lesson of all. And that brings this edition of Intelligent Investment Today to a close. I do hope you've enjoyed the episode and it's acted as a timely reminder of the differences between the efficient markets hypothesis and the Benjamin Graham approach. If you have, please do consider subscribing or adding to your playlist so you need never risk missing a future edition. I'm David Coombs. This has been Intelligent Investment Today. Until next time, stay safe and happy investing.